Welcome back to Behavioral Finance and FinTech. I am Andy Kim, your Dr. Finance, and this time we're going to talk about JP Morgan. Number 65. What does this mean? If you look at JP Morgan, the CEO is Mr. Jamie Dimon. His age this year turns out to be 65. The next thing about it, he wrote 65 pages long letters to shareholders this year. Well, if you look at the letter to shareholders of Warren Buffett, 14 pages. 14 pages only. So 14 versus 65, now you see that difference. 4 times or more. Now, what did he have to say about the situation? So much so that he had to say that much in the letter. Is that he says, it's so unfair. There's just nothing we can do as conventional bankers. What are you complaining at? Here is a URL. You can click it and read it through. 65 pages. You can go ahead and read it in your free time for your reading pleasure. But this is the key point that I find. Okay, he lists up 11 points by contrasting the existing bank, JP Morgan kind of guys, big banks, versus the BigTech companies or FinTech companies. If you want to say TechFin companies, fine. Okay. So what's the challenge over here? Number one, he says the banks, right? We have higher capital requirements, which also require expensive debt and non-tax deductible preferred stocks and even on deposits, right? A lot of capital we need to prepare. But FinTech companies, they don't have that much, right? They're lower capital requirements set by market. And then that's unfair, he says. And number two, operational risk capital. Okay, they have to prepare. But FinTech, no operational risk capital is required. It gets back to the concept of Basel III, capital accord kind of things. The purpose of having this accord among the banks, existing banks, is to have a financial stability in your country. Financial stability is such an important concept. If you don't have enough capital in your banks, right, to cope with this kind of risks, right, then you're screwed. You have to make sure that the banks are well capitalized so that they need to have all capital requirements and then operational risk capital in their balance sheet. If you don't have it, get out of here, right? That's financial industry, bank industry. But FinTech, they're coming into finance industries, competing against us, but they don't have this kind of requirement and they are free, right? They're so much flexible to do anything they want. But if you think about financial flexibility of the country itself, right, whole system, it's dangerous. That's his argument. Okay, it makes sense, right? And number three, he says extensive liquidity requirements we suffer from. But FinTech, if you look at it, there's no such liquidity requirements. It's unfair. Number four, we have to abide by this FDIC insurance, 예금보험공사. This cost JP Morgan $12 billion over the last 10 years and not tax deductible beginning 2018. But FinTech, no such insurance. It's unfair. All right. Number five, UK bank levy and surcharges. Okay. And it cost JP Morgan $3.2 billion over the last 10 years. But FinTech, no such requirements. It's what? Unfair, yes. Number six, okay? More costly regulations like loan and CFPB and OCC, all this kind of, right? Office of Currency and Controller and this kind of regulators. They look at this bank so closely, right? Including resolution planning and CCAR. You don't need to understand all this kind of buzzword, the words over here. Don't worry, I'm not going to ask you, but essentially heavily regulated. But number six, FinTech companies, less costly regulations. Unfair again, right? Number seven, heavy restrictions around privacy and use of data. Okay, privacy concern, all these kind of things, heavily regulated. But number 7 in fintech, fewer privacy restrictions and virtually no data restrictions. They can do whatever they want based on those customer data they got. It's what? Unfair. Again, yes, thank you. And then number 8, extensive KYC AML requirements. What is that? Know your client. I'm going to ask you these words, right? KYC, it's an important word. And AML, asset management, what is that? AML requirements. But the fintech, they don't have this kind of requirements, right? Again, it's unfair, right? Thank you. Number 9, substantial social requirements. We have to be good, socially responsible, right? We have to show that demonstrate that we are a good social citizen. But number 9, fintech, they don't have such social requirements. It's what? Unfair. Yeah, of course. There's a reason why the banks have this kind of requirements. You remember what happened in 2008, right? Financial crisis in global scale. They deserved it. They invited this kind of situation. But now, 10 years later, they feel it is unfair. Okay, fine. Number 10, extensive public and regulatory reporting requirements. We need to disclose so many things. But number 10 over there, fintech, limited public and regulatory reporting requirements. It's unfair, yes. Number 11, lower revenue opportunities. Right? The market is deplete, right? But in fintech, higher debit card income is there. The fee they receive is so much, right? It's unfair, right? Thank you. So that's the key message in his 65 pages long letter to shareholders, which largely makes sense, right? And he also praises big tech firms in the competition. He says the service of the big tech companies are intuitive and simple and fast. That's something admirable. And it's using social media data that's creative, and then combining fast with other platform services. So that's very creative and making it flexible to serve the clients, the customers, right? We wish we could do that, right? They say it. And fintech and big tech firms would have to be cautious in the future. He also warns it nicely. Welcome to the world of financial supervision. Welcome to the dark world. And then once you guys come here, your creativity would soon be choked. You guys touch the Pandora's box in a sense, right? And then taxation problem in digital products and services. It's going to bother you. And information security for personal data, good luck with that. Okay? Would you be monopolizing all those data or not? It's a key critical issue there, right? And an antitrust, anti-monopoly regulation is also there. How would you tackle those? And unfair treatment of the apps of their own if they are launched on their platform. So, platform discrimination, right? Kakao platform versus Naver platform. Depending on the platform origination, you discriminate your own fintech services against the other competitors. That's not fair. You're going to be bashed soon. That kind of things. And then he says JP Morgan is also working hard as well, right? And then they are perceiving some of the risks down the road. One of the key issues in this area is cyber attack risk. Yeah, it's non-trivial, okay? And then, lo and behold, this is not JP Morgan, but outside JP Morgan, like outside conventional banks, the DeFi, so-called, right? Decentralized finance or cryptocurrency world, right? In August, right, this year, August 11th, a very funny event happened, right? Hackers returned nearly half of the $600 million they stole in one of the biggest crypto heists, like cryptocurrency exchanges, right? And then a couple of days later, nearly all of the $600 million stolen in a huge crypto heist has been returned. Maybe the hackers, had a smaller heart over there, right? Did not have the beast's heart or something like that. Kind of spooked out. Maybe he was or she was trying something as a way to poke it, and then really $600 million. The thing is, the cryptocurrency, right? Blockchain technologies, is it fraud free? Okay, is it always the safest asset? Good luck. That's the message here. And then almost a week later, there comes Japanese case. More than 90 million US dollars worth in cryptocurrency got stolen after the top Japanese exchange is hacked. Come on. The purpose of having those blockchain-based currency, one of the reasons was to prevent this kind of, hacking problem. But it's still there, right? What's the purpose of having all these things? We have to think about it critically. I'm not saying that this is totally bullshit, but there is a pros and cons. Okay, haste makes waste. We have to be critically understanding all these things, right? And the banks are trying to be more conservative to prevent this kind of risk, right? And then COVID-19 and the economy, the JP Morgan goes on saying this. FRB, Federal Reserve, did a great job of handling the crisis in 2020 by bold actions in monetary policy. Great job. They have to say something good to the regulators. Of course, yeah, baby. And then in fact, you guys could do it because the banks maintained strong balance sheets before the crisis. Remember, we tried to follow your regulations. That's why you guys could do that. Seriously, yes, that makes sense. If I imagine the Lehman Brothers crisis kind of things happening together with COVID-19 crisis, that's going to be a perfect storm for the whole world. It's going to be the end of the world, right? The only way getting out of those crises could be maybe a third world war or anything. But thanks to the crisis that happened 10 years before, okay, the financial system got ready, got more stable over the 10 years horizon. That's why we could endure all these kind of things last year, at least until now. And good luck for the rest of the future, okay? Going into the future, there could be some missteps among the policymakers in fiscal policy and monetary policy and the financial supervisors, so we wish you good luck. That's his message. And then JP Morgan, right? He says, if you look at the balance sheet of our banks, we got much more stable. In 2000, if you look at the bank deposit and then loan ratio, right? It was like 99% of the loans that you got from your clients, 99% of them, right, were loaned to your corporate borrowers, right? 99% or 100% of them, right? A lot more risky, but these days it's only 64% like this, okay? Loans to deposit ratio. A lot stabler balance sheet. That's what he says, what he argues, right? So that's an interesting part of it. Now, financial stability is now back. So that's why we could afford to have all these kind of or quantitative easing kind of policies, monetary policies. So that's what the current banking situation is now. But you see clearly those 65 pages long complaints, right, about the situation of current bank against as they face the challenges coming from the FinTech companies. We can see the pain points of these banks, where they feel pain. At the same time, the FinTech boom or the bubble, you see where they will stumble in the future, right? One good example is actually Alibaba, the Alipay, right? And financial, right? More specifically, Ant Financial. If you Google search it, what happened to Ant Financial last year? They were about to go to the IPO. And then 3 days before the IPO, it was crammed down by the central government of China. And they said, no, right? Why no? Because you should get regulated just like other banks. Those capital requirements and all these kind of things. Plus, you guys were trying those financial securitization, right? Mortgage-backed securities and all this kind of stuff. You boast on them, right? Oh, and the USC, Alibaba's CEO, right, was boasting on having all this financial innovation. We are bringing all these kind of things back here. But remember those complicated derivative securities, right? MBS, ABS, and then CDO and CLO, that kind of things, right? Or CDO squared, right? Those are the culprits, the key culprits that caused the bubble and bust of 2008 global financial crisis. And you are bringing it back to China? No way. So, boom. Of course, there is a political reason why, they say, some people say that maybe some of these Alibaba key officials are not friendly with the central government people in China, like Xi Jinping or some big guys. Maybe, but the major issue, you see, okay? So those FinTech, we welcome FinTech. Oh yeah, everything sounds sexy, but we should be careful as well, okay? Haste makes waste. And then you should be having some critical understanding of all these things, pros and cons, right? So remember those, and then wait for thanks for watching it, and then see you in the next lecture. Thank you.